It's great to be back at another summit here today. Really looking forward to chatting to you about a few things Solaris orientated. I was asked to basically pitch a concept or an idea to you today, and the concept I want to pitch to you is there on the screen. Shorting doesn't have to be risky, and it's in relation to our long-short fund. And really, that's very much in contrast to the stereotype that you see in the media about shorting. The opposite, as is often the case about stereotypes, is true. Used effectively, shorting techniques can actually enhance returns without having a commensurate increase in risk. So how do we do that? Well, let's hop into it. At Solaris, we run a 130-30 long-short fund. So what on earth does that mean? That means we go short 30% of the portfolio and we go long 130% of the portfolio. And at the risk of being schadenfreude, it's really good fun shorting. We really enjoy it. There's something innately satisfying about monetising your negative views, and you get to enjoy the fruits of the second half of your research efforts. Long-only funds, which we also run, only get to enjoy the fruits of your positive views. Shorting, as I say, is a really good fun to run because you get to enjoy the pursuits of your negative views. The three types of shorting techniques we use at Solaris, and we do short a little bit differently at Solaris, are up there on the board. In the yellow is the typical, stereotypical shorting approach. Now, that approach sees you, and that's the one that gets all the bad press, that approach sees you take a short position without a commensurate long position. So it's a naked short. And the activist shorts up in my neck of the wood in Brisbane with corporate travel, Blue Sky and Glaucus gets a lot of attention. Can be really effective, but is much higher risk, much higher volatility, and attracts a lot of the negative attention. Like so many things in life, it's the quiet achievers, the unsung heroes that go all right. And for us, that's the other two, funding and pairs trades. And they achieve a great contribution to our alpha without having the commensurate increase in risk. So let's have a look at them. I don't have time today to go through the funding, but I will go through the pairs trade in a bit more detail. And that's what we're trying to demonstrate to you, that nirvana of getting higher returns without higher risk. So, what is a good pairs trade? Well, the attributes for a good pairs trade are two stocks, usually in the same industry, usually homogenous, and therefore have a common, usually top-down risk associated with them. And they become mispriced relative to each other. One's expensive, one's cheap, and simply you go short the one that's expensive and long the one that's cheap. The first example up there is Altium versus, and it's taken me a long while to get Mr. Miyagi of Karate Kid fame into one of my presentations, but it is great to see him staring back at you. And why is Mr. Miyagi up there? Well, he represents the WAX stocks, our version of the high-growth, stratospheric PEs that we see in our high-growth software stocks, the FANG stocks of Australia. WiseTech, Altium, Appen, Afterpay, and Xero. And my kids really wanted me to do the hand actions, but I'm not going to do that for you. Altium represents wax on. Mr. Miyagi represents wax off. And we've held Altium for quite a few years in the portfolio. We really like it. But as its share price has gone almost vertical, it's up 80% in the last 12 months, we're starting to struggle with the valuation now. And the chat with you guys is really well timed because it's only just recently that we've moved from a naked long on Altium with no offsetting short to saying we can't really get there anymore just on the valuation. So we've offset it by going short a basket of the other wax stocks, wax off. And it's a really good way for us to risk manage this very difficult sector of the market. So why do we like Altium? Altium's got a lot of really interesting attributes. It's got fantastic revenue CAGR of 20%. It's got almost double that in EBITDA growth over that period, in growth. And what it does is it makes the software that designs computer chips, PCB, printed circuit boards. Gordon Moore in 1965, the founder of IBM, said that the number of chips, computer chips, in the economy would double every 2 years for the next decade. And then in 1975, he revised that to say that the number of chips in the economy would double every year for the foreseeable future, and he's been wildly pessimistic in that forecast. You just think about this room. We've got smartphones, watches, tablets, laptops, the countdown machine in front of me telling me to hurry up. Like everywhere, there is chips required in our economy, and the exponential growth that we've had in no way looks like it's slowing down. So when you are the market leader in that growing market, it's pretty nice. What they've done though is combined that with really strong market share growth. And you know, you need a pretty good memory. Some of you in this room, the way Mark introduced me included, would be old enough to remember Lotus 123. It didn't matter back then how much you liked Lotus 123. You didn't have the choice to run with that program. You had to come onto Excel because Microsoft's market share was so great. If you loved your Nokia brick like a brother, you know, you didn't have a choice to stay with your Nokia brick. You had to go to the Apple smartphone, whether you liked it or not, because everyone else went with the Apple smartphone. So technology can reach this tipping point, which is very powerful in terms of retention, competitive advantage, barriers to entry. And if you're a young MIT graduate leaving Boston looking for your computer engineering pathway, you are already Altium literate. You're already using these programs, and you need to be Altium literate to forge your career. So it's a pretty nice place to be. What's the problem? Well, to be fair, it's a nice problem to have. It's just gone up too much, and we can no longer justify the valuation. So what do? Well, we come to the wax-off stocks, the basket of stocks in this sector that we don't see as having the same competitive advantage. We don't see as having anywhere near. Now, Altium's not cheap, but it looks cheap compared to the other wax stocks. The yellow line is the performance of the All Ords over that period, S&P, the 200, pretty good. You're all familiar with that over the last 4+ years. The FANG stocks is the next one, sensational, and eye-wateringly vertical is the wax stocks. Now, within this, we've got a company that has a market cap of $7 billion that doesn't make any money yet, is in losses still. We've got a company that is on 120 times plus earnings that has largely grown through acquisition, a much more aggressive way to grow than the organic growth of Altium. We've got a company that capitalises all its R&D expenditure compared to Altium's expensing it all. We see Altium as having a far better mix of products and competitive advantage, and it's cheaper. Now, it's not cheap versus the rest of the market, but it's cheap versus this. So we pair them up against each other, and that's how we manage our risk. The important point I want you to take away from this is we would never do a naked short on the wax stocks. It would be insanity. Look at that line. At what point would you be confident enough just to take the short against all of them? We pair them up to manage the risk. And just to emphasise just how far we've come as a market, possibly not the gong you want coming first, the median PE of high growth stocks in our market is much higher than the rest of the world. So that's one example. Gold is a classic, or any commodities is a classic example in this, probably the more typical example, where you have no visibility on the ability to forecast the biggest driver of the sector. How can you have gold investing when you put your hand up to say, I can't forecast the gold price? Well, you pairs trade. You take two gold stocks. We find it much easier to pick stocks than stock markets. We find it much easier to pick stocks than styles. And indeed, we find it much easier to pick stocks than commodity prices. And so we pick our preferred gold price, our preferred gold stock, and we pair it up against our least preferred. In this case, Newcrest is our least preferred, and that doesn't look much good. The gold price has gone up 20%, and Newcrest has gone up 45%. Prima facie, not a good outcome for our short. But we've paired it up against our preferred long, being Northern Star, a geologically really simple gold mine, really well managed with good capital management, which is a rare thing in resources. And it's gone up just under 70%. And so net, we've won on the pairs trade despite the short actually going against us. And there's lots of examples like this. 12 months ago, we stood up here and told you that one of our big pairs trade was Macquarie long, AMP short. We've still got that trade on today. That's been one of our most profitable trades. And what we're eliminating there is the equity market risk. They're both equity-facing stocks. So, but we've had a really good time on that. And every time we look to close it out, AMP finds, another way to find a new nadir. we don't need to trample on that story. It's been very well publicised. So there's lots of ways to do this, and lots of ways to achieve, possibly the best way to achieve, that nirvana of increased return without commensurate increases in risk, quite contrary to the stereotype surrounding shorts. So that's all I wanted to say today. I'll leave you simply with our performance, and I'll note on that the last two orange bubbles, that is the alpha we've generated from the lower risk parts of the long-short fund, and it's more than 50% of the alpha. So again, the unsung heroes, the lower risk, have been really effective. Thank you very much for your time. I hope you enjoy the summit.